What's going on, investors? AK from Fallible here. And today I want to talk about the difference between trying to predict what's going to happen in the market versus weighing probabilities of what's going to happen. They are two very different things. Now, lately I've been making a lot of videos covering what's been going on in the markets. October was a scary month, you know, you had Halloween with all those little kids in their Fortnite costumes flossing and dabbing everywhere, just being annoying as hell. And then you had all the volatility in the market, so people were rightfully worried about what was going on. And in my videos, I was taking the technical, sentiment, and fundamentals of the market, putting them together and trying to see where prices would go from here. Now, when I say I'm trying to see where the prices are going, I don't mean I'm trying to predict where the prices are going, because that's impossible. It's stupid. What I'm actually trying to do is evaluate what the highest probability scenario is. So I'm trying to find the path of least resistance for the market. So if I think there's a higher probability of the market going one way than another, then I'm going to place a bet in that direction. And that's what trading and investing is. And you want to hear a story about the difference between probabilities and prediction? Well, I got one for you. Recently, I was in San Diego, and in San Diego, everyone loves going and seeing the seals. And you know what seals are, you know, they bounce around beach balls, they bark like arr arr. And actually the most famous seal is the presidential seal, who is handpicked by the president to validate documents, and that's been going on since the beginning of time. Every time a new president comes in, he kills the old seal and picks a new one. But anyway, San Diego, everyone loves seeing the seals. And not only do they love seeing them, but they like going on the beach and going really, really close to them. Now, I saw this and I said, hell no, you know, I'm not going anywhere near those seals. They're wild animals, they're not cute, and they smell. AK doesn't do those things. But everyone else was doing it. Now, in this situation, I couldn't exactly predict what was gonna happen, but I knew there was a high probability of something happening, because when people mess around with wild animals, you know, something happens, something bad. So if there's a higher probability of something happening based on the circumstances, I would be fine placing a bet, just like in the market. And sure enough, one of these girls goes down to the beach and is 2 feet away from the seal and is taking a selfie with her boyfriend like this, when the seal runs up and takes a chunk out of her calf. Yeah, the seal, because he's only 2 feet away, just walks a few steps and takes a big bite out of her leg, and she falls over, and the whole beach gets silent, because no one could have predicted that the seal would have done that. But AK knew there was a high probability. So the girl gets up and she's limping back up the beach, and her boyfriend's right there like, oh damn, now I gotta deal with this. The vacation's ruined and there's blood everywhere, and I'm trying not to laugh, but it's tough. But the point of the story was that I couldn't have predicted that that girl was gonna get bitten by a seal. But based on the situation, I knew there was a high probability of something like that happening. And when you see a probability in your favor, you wanna bet on it. And you wanna make sure that that bet is asymmetric, which means you got a lot of upside and limited downside. So in my case, I didn't actually bet on someone getting bitten by a seal, because there's not much upside to that other than my own joy and satisfaction for them being dumb. And I guess the seal is happy because he doesn't have to hunt for fish that day. But the reason you want the bet to be asymmetric is so that most of the time you can be wrong and still be okay, because on those few times that you're right, you'll make a ton of money. So there's a lot of investors that have win rates as low as 30 to 40%, but they're still doing really well. And that's because when they do win, they win big. And they're allowed to be wrong most of the time. Because even in those San Diego beaches, most people aren't getting bit by seals all the time. If they were, you'd hear about it. There'd be an epidemic. And then Trump would be focused on stopping seal caravans from crossing into our oceans. So it's important in markets to always remember that you're just weighing probabilities, you're never predicting. And that's a good mentality to have, because if you think you're predicting something, then you're gonna get attached to that prediction. And it's terrible in the markets when you start believing your own BS. If you believe in probabilities, you know there's only a chance of you being right. If you believe in predictions, then you really think you're gonna be right no matter what. And that's why you get these perma bears that have been wrong for years. They've made a call and a prediction and stuck to it for so long, no matter how many times they've been wrong, no matter how much money they've lost the entire way. If you start making predictions, you lose your fallibility. And that's when your perspective gets all distorted, you start ignoring new information, and you're just stuck in that one prediction you made. You never want that to happen. So when I make these market videos, remember, I'm just weighing probabilities. I'm not making predictions. And wherever the higher probability is, that's the way I'm gonna make my bet. And if you wanna see more of those videos where I weigh probabilities, then make sure you subscribe to this channel and hit that bell for notifications of the new ones that come out. We release 3 a week, all market and business related. So subscribe, and I'll see you in the next video. Stay fallible out there. Bye.